Hi, we're going to get started today by looking at the S&P 500. This is a very dramatic overbought market. We've been overbought for 2 months. No, 1 month, 2 months, 1.5 months, and we keep going up. So this is this is an example of a time when you start either scaling back or don't buy because we are overbought right now. Let's look at let's look at our talking points in our calendar. You can see that we've gone through all of our earnings season, basically. We have one big report for the tech stocks next week, and it is NVIDIA. That's coming out on the 20th. Then we have a holiday. So a lot of people are really um, happy around the holidays. So we like to think that the stock market does well around that holiday. And we also have options expiration. That is this coming Friday. So let's look at our stochastics for the S&P 500. You can see we have a well-defined channel going back over a year, and we're at the top end of our channel, and we're seriously overbought. So all it takes is one bad news story, and we could correct down to the bottom of this channel. Um, I'm 100% invested right now. I'm not trying to time the market, but whenever I have some extra money to put into the market, I like to I like to put it in when everyone else is selling, not when everyone else is buying. So right now everyone is buying, and there's cheers in the air. So let's look at our meeting notes. Okay, so we have this past week we had AMD report earnings, and their stock went up a bunch. In the past week. They had a really good earnings report with good guidance. So the semiconductors are on fire right now, and they're doing really good. And we're going to focus on the semiconductors in this talk, just because on Friday they all went up 11 to 15% a piece. So, and not every semiconductor is the same. So we have Walt Disney reported their earnings. What's interesting about what's interesting about Walt Disney, their stock hasn't gone anywhere in a long time. And so let's look at a chart of Disney. Hold on for a second. Okay, there it is. Let's go back multiple years. This is pretty interesting. If you go back, this stock is not, it used to be a growth stock, but right now it's like in a sideways pattern. It hasn't gone anywhere. We're gonna look, we're gonna go back as far as we can. 2015. It's the same price it was in 2015. So Warren Buffett wouldn't be interested in a stock like this. Um, it's pretty overpriced. And they have a lot of issues. Right now, they have the ABC on the TV, and that's in secular decline. And they're trying to make the streaming work, and they're kind of trying to make money at that. So they're not as robust of a company that Warren Buffett would normally look for. We had McDonald's. They had a pretty good earnings report. They're growing around 2 or 3% a year, and but they most important thing about McDonald's is they pay a dividend. There's a lot of people interested in dividends, and that's the only reason I think I would buy, but I wouldn't. Um, okay, let's look at I have to wait for this to catch up with us. Okay, let's look at the next week of earnings. You can see Cisco is going to be basically the big stock reporting next week. Um, they're kind of an old school company. They bought a company that allows them to have a software recurring revenue a part of the business. But in general, it's not interesting to me because it's not really growing a lot. They have a lot of dealers in the AI infrastructure, but it's the only stock that's big that's reporting next week, but it's not going to move the market if they do bad or good. Let's look at some of our statistics. The S&P was up 2.2% this week. That's pretty good. But the the stock market isn't really, it's interesting. We only have 52%, 51% of the S&P above the 50-day moving average, 53% above the 200. So we don't have a true full participation of the whole market yet. So that's interesting. The 10-year is basically unchanged from last week, and we're overbought on the S&P short range oscillator. So this is all kind of telling us that the market's kind of topping out now, and it's not a good time to start buying. Let's look at, we are right in the middle of May. May is traditionally a good month. Um, so we always have a positive bias going into May, but June uh, is a flat month usually on average, seasonality wise. And then August, September are bad months. So we have to keep that in mind and position accordingly whenever you're ready. If you have some extra money to invest, there's a very good chance in August, September, we're going to get a better chance to buy those stocks. Okay, let's look at we already looked at this. So the S&P short range oscillator is 1.6. That means an S&P short range oscillator value above point plus 5 suggests the market is overextended to the upside and due for a pullback. So we're at 1.6 now. We're not totally overbought, but um, it's just a signal that not a good time to buy or to establish new positions. Let's look at the 10-year Treasury. This is interesting. The 10-year Treasury is kind of going sideways now. It was going down in the last week, but now it's kind of going sideways. But the stock market is going up. That is interesting because usually there's a um, inverse correlation between the two. So this week we actually had, last couple of days anyway, we had the the yield of the 10-year Treasury go down. So we can't, we don't have 100% correlation this week. Okay, let's look at the price of oil. Last week was 101, and now it's 94. So it's down 10%. And that's really positive for inflation. It basically, the price of oil is going up and down based on tweets coming out of the president's account. Promises that the war is going to end. You know, every day we have a different news story about the war. And right now, the market believes that that Iran war is going to be over sooner than later. And let me see. We have no change in inflation from last week. The price of gold, we have an inverse correlation here. The dollar is down, dollar index is down 1%, and we know when the dollar index goes down, a strong, wait, a stronger US dollar tends to drive gold prices lower. But the opposite is true. A weaker US dollar, like happened this week, tends to drive gold prices higher. So that correlation worked this week. And the US dollar index is kind of going sideways for the past year or so. So that's very good for the stock market because that makes earnings consistent for companies, that you won't have as many companies blaming the currency rate for bad earnings. Fear and greed index. We are greed the same level as last week. So our translation is when the stock market is greedy, take some profits off the table or don't buy. And all right, so we have the AAII Individual Investor Survey is bullish right now, and we have another confirmation that whenever the amateur investor is bullish, you take some profits off the table or don't buy. I inserted an interesting chart here. You can see the S&P 500, the yellow line, as it goes down. You can see in 2008, the amateur investor is red, which is they're fearful. So there is definitely an inverse correlation in the whenever the individual investor is bullish, that's usually because the stock market's going up, and that's a contrary indicator. You want to take some profits at that time. Okay, the VIX is kind of flat, and that is like a bull market. It's kind of low. People aren't really afraid right now of the stock market going down. We have right now we have like greed in the market, so people are not afraid and they're delusional kind of right now. And okay, let's look at some of the most undervalued sectors in the market right now. Financials are undervalued, energy, and we have IT are the three most undervalued sectors. So establishing new positions in those um, would um, would be a good thing to focus your searches on. Okay, let's look at the sector performance from the beginning of the year. Energy still seems to be the best performing sector this year. IT is next, and materials, communication sector. The worst performing is healthcare. This is like the third or fourth year in a row that healthcare is underperforming. Um, and financials are underperforming also, down 6% this year. Actually, the S&P is up 8.08% this year. So we're actually doing pretty good this year. That's like an annual return of around 18%, which is better than most years. Okay. Okay, let's look at the stocks going up and down. Okay, so this is, we had a big rally in chip stocks this past Friday. We had AI infrastructure related stocks. We had SanDisk, Micron, Intel, all up 15%, 13, 14%. Companies like Dell, they make AI infrastructure servers. And AMD is another semiconductor. So this was a huge rally day for semiconductors. I thought it'd be appropriate to do a little research on that sector to see if there's any good stocks still available. There's a Morningstar article. Will 2026's top stocks keep riding the AI infrastructure boom? And the title is the best performing stocks in the Morningstar's coverage list are seeing the business and valuations surge. So we see that the stocks they're talking about here, Western Digital, Oracle, SanDisk, Bloom Energy, Seagate, Apple, and Intel. So basically what this article says is every one of these stocks are going up because their earnings prospects are going up with it. So SanDisk is actually the best performing stock this year, and it's risen 464%. And let me see. And there's an immense demand for AI related computer hardware. And every one of those companies actually meet that demand. So the top performing stocks, you can see that Intel, Western Digital, Seagate, SanDisk, and Bloom Energy. The key points of this article, the earnings were propelling the best performing stocks. So the earnings estimates are going up, and that's leading the stocks to continue. So it's not necessarily an AI bubble. So there's another thing here. It says long-term cyclicality remains a concern. So cyclicality means there are different cycles in the market. Right now, there's a boom, and in this sector, there's often a bust. I mean, all these stocks will go down 40% to 50% in the next cycle. So we don't know when that's going to happen. Right now, the earnings estimates are going up, and the analysts are expecting better earnings in the future, and that's why. Um, but we don't know when there's going to be an overproduction of these. And the other thing to keep in mind is a lot of companies are double and triple ordering now so they can get their orders in before the prices go up. So that might artificially make the orders seem like they're going to be going on like this forever. Maybe in a year, there's going to be a bust where no one's buying the chips anymore. So you can see the best performing stocks so far this year: SanDisk, Bloom Energy. Then we have Intel, Seagate, Western Digital. So I thought it'd be interesting to look at these if the fair estimate of SanDisk and if SanDisk's fair estimate. You can see that as the stock is going up, the fair value of that stock continues to rise with it. So fair values are very important. Let's look at Bloom Energy. You can see that they're pretty much getting away from their fair value, which is only $70 a share. So for Western Digital, look at this. As their stocks has gone up, their fair value has gone up with it. So we're going to look at Western Digital a little bit later. And let's look at Intel. You can see that Intel's fair value is $90 according to Bloomberg, Morningstar, but their current price is about 20% higher than that. So let's do a little research. Um, oh, I forgot to go through the other sectors. Hold on for a second. We'll revisit these stocks a little bit later. Okay, let's look at some of the stocks going down the most. We see Expedia. Why would Expedia be going down? Maybe ChatGPT, could you find me a flight and a hotel room in a tropic destination under $300? And that could totally replace Expedia. So Expedia doesn't have a moat either. Actually, Google owns the back the database that they use for all of their transactions. So they don't have anything proprietary. So I wouldn't invest in Expedia. Um, Motorola Solutions, Fidelity, I don't have any understanding of any of these. Um, we have some software stocks going down again. Software is AppLovin. They make apps. They do advertising for apps. We have Axon Enterprise. A lot of these stocks have gone up a ton in the past year, and they're giving back a little bit. Okay, that's all I can find from that. Let's look at the sectors going up and down. Semiconductors and the tech stocks have definitely outperformed today. And you can see the semiconductors going up 15% or more. Um, Gold miners have gone up a lot, and telecom. Let's look at the stocks going down the most. Utilities, healthcare, financial. Okay, so we have basically a risk on day in the market here. Risk on meaning all the conservative stocks are going down the most. These sectors here are the most conservative, and no one wants conservatives when all the stocks are going up 15%. And these are the risk on stocks. Okay, so that was a good, interesting thing to go through. Okay. Okay, I asked Google, what's the current stock market narrative? And Google said AI and tech dominance. There's insane growth in that sector. Um, there's high profit margins and strong growth expected for all these tech and AI infrastructure stocks. Um, we have a, we have an economy that's very resilient, and the job market is good too. We have um, higher for longer sentiment. That means we're not going to get rate cuts in this year. The Fed's strategy is to remain on hold with only one rate cut potentially arriving late in the year. So what that means, the stock market has a tendency to go up whenever there's rate cuts. Whenever where they're on hold, there is no wind behind the stock market's back. So this kind of tells us that the stock market is going to go sideways. When in doubt, it's going to go sideways because there's no real push on the stock market with lower interest rates. So key risks and contrarian views. Warren Buffett still has a good portion of his positions in cash. So Warren Buffett's waiting for a better time to invest. So that kind of is like saying he hasn't found anything now. He's waiting for a crash before he invests. Um, Market breadth isn't very good right now. Right now, there's a handful of companies that are causing the stock market to go up. So that kind of mirrors our 50% of the stocks above the 200-day moving average. So it's not the whole stock market going up. Okay, so I thought this was an interesting stock, and we have the NVIDIA earnings coming out next week. You can see that we're in a sideways pattern for at least a year. This stock has grown at 70% a year, and the earnings are coming up. So a lot of times, whenever you have an earnings report coming up, and right now what happened is we have a buy in a rumor. Sometimes whenever you buy into a print or a earnings report, you sell on the news. So don't be surprised if we hit the bottom end of this range or go down to here on a bad earnings report, or maybe they didn't report good enough um, estimates going forward or something like that. So you got to be ready for that. Buying a rumor, selling the news whenever they report. Okay. And this article is pretty neat. This is an article from Yahoo Finance. What's driving the rally in memory chip stocks? This also corresponds to that article we were just reading right here about will 2026's top stocks keep riding the AI infrastructure boom. So the key notes from this talk, right now, Micron's selling for a PE ratio of 7. Others in the same sector sell for a PE ratio of 30. That means Micron's valuation is 4 times less than the semiconductor sector. He likes the analog sector also, the analog devices. Analogs, analog devices are companies that focus on converting real-world signals such as temperature, pressure, and sound into digital data, crucial for the growth of the Internet of Things and automotive technologies. So those kind of companies are Analog Devices, Texas Instrument, and Monolithic Power Systems. So I thought it'd be interesting to grab the first couple here he mentioned and go over them just to see if they had any credence. Um, there's another little article in that same movie that says, what are the bottlenecks for semiconductors? Right now, CPUs, memory, and optics are important parts there's not enough of these parts right now, and they're allowed to actually raise their prices because of the lack of the demand for these. So this lady says the bottlenecks will be around until 2027. That means we have at least this year and next year where these stocks can continue to grow at their current rate. Um, let's go over SanDisk. Um, their earnings are from last year to this year, 2,240% growth. Look at that, $2.71 earnings, and this year is $63. That is pretty amazing. So from this year to next year, they're going at 169%. So if they're going at 169%, the PE ratio is 24. So the PEG ratio is 0.14. They're 7 times undervalued according to that. Here's another one. It's called Lumentum, and the symbol is LITE, light. And you can see there's decelerating growth. It's 312 from last year to this year, 124% this year to next year. And their PE ratio is 59. So they're about half off right now, because if they're growing at 124, you divide 59, the PE, by 124, and you get 0.5. That means it's 2 times undervalued. Let's look at AMD. They just reported this week, and they went up a ton. You can see they're growing at 57%, and their PE is 59. So their fair value is right where they're at right now. So they're fairly valued with the PEG ratio of 1. So I wouldn't be interested in this one right now because it's basically fairly valued. I'd wait for it to go on sale. And we've been talking about Micron for like all year long. Right now, its growth rate this year is 11%. Its PE is 7, so it's but look at this growth rate for 27 to 28. It's almost 382. So that's another one we've gone over before, so I'm not going to go over it this time. I thought it'd be interesting to go over Intel because Intel is one of the best performing stocks this year. You can see that from this year to the next year, they're expected to grow 39% and then negative 4%. So this is a very expensive stock. They're growing at their PE ratio is 159 and their PEG ratio is 5. So they're at least 5 times overvalued. And all their profitability is all negative numbers. So and they have negative free cash flow. They just made a deal with Apple to do some of their semiconductor manufacturing. So maybe the stock got excited on that news, but right now, even after the analysts had a chance to update their estimates, I don't see a very good stock right here yet. So we'll keep our eye on that. But it's if you buy it right now, it's like gambling because it's just they don't have any good numbers. All these numbers are kind of negative. So keep that in mind. Here's a stock, Western Digital. This is on, this is one of those stocks that are on the best performing. Um, Here it is, Western Digital. They basically make hard drives and internal data center drives, data center platforms, external drives, portable drives. And they have a high demand for this in the data centers. And you can see that their growth from this year to the next year is 73%, which is pretty good. This is decelerating growth. Um, right now, their forward PE is 25. So that means that they're basically one third off, because if you divide the price to earnings ratio, which is 25 by 73, you get zero point 0.3. You can see the profit margin is really good. That's 5 times what we're looking for. Return on equity is 8 times what we're looking for. And they have um, they have more cash than debt, so that's not even an issue. And they're very profitable with 2 billion in cash flow. So this is a decent company. Let's look at their stock. You can see it's going parabolic right now, and it's pretty dangerous. And we've been overbought for 2 months. So um, so it's dangerous to buy, but it's still undervalued. So we'll keep an eye on that one. Let's look at what CFRA said. They said it's a buy, and they say it reflects our favorable positioning to capitalize on AI-led data storage demand, which we see as a structural multi-year tailwind. WDC's transformation to a focused HDD pure play enables sharper execution following the spinoff, while leverage has come down significantly. Robust near-term demand, margin expansion, and secure multi-year customer commitments through 2029 position this company for its sustained growth above 25%, with the company continuing to execute its roadmap and bring higher capacity drives to customers. Okay. In their fair value, look at that. It's 771. So according to them, it's about half off. It's undervalued by 60%. So you can see the earnings. I like to see stocks that are going up 10% on a regular basis at least. But you can see we have 2 years where we had negative earnings, and we had negative earnings here. So this is a stock um, that those negative earnings we see in these years, like 2029 and 2020, um, this is what the analysts call cyclicality. Some years you have a boom, and some years you have a bust. And right now we have a boom. We don't know when that oversupply is going to happen, and they won't be able to charge as much. So you got to keep that in mind if you're a long-term holder of this company. Let's look at what Morningstar said. They said, hold on for a second. Right. They said the price is basically fairly valued where it's at right now. It may be overvalued by 5%. Okay, so let's look at our stock screen. Micron, of course, is um, we've been highlighting all year long. It's about 5 times undervalued there. And you can do a quick understanding of how much a stock is worth by looking at the PEG ratio. If it's 0.2, it's 5 times undervalued. If it's 0.74, it's 25% undervalued. And GE Vernova, it's 0.445. That's like half priced. So I didn't really see any really good combination of stocks to add to start looking right now. Um, Let me see. I didn't see any really good tips this time. So, but you can see what I've done is I've highlighted the most important, the best performing in every column in green. So we have, um, for instance, we have MasterCard with a return on equity of 206. That's one of the best, so it's green. I like to look at stocks like this, where they're all green the whole way over, and that's a good time to research it. Apple Oven is actually a company it's in the bullseye of the software sell-off. They make apps for maybe advertising for apps, and there's a fear that this might be um, taken over by AI and displaced. So I don't want to get involved with that. It's a smaller company. I like to look at the bigger companies. Okay, so that was good exercise. Okay, so I also wanted to go over every once in a while, like once every quarter, I like to go over the top holdings in mutual funds. Let's look at the Fidelity Magellan top holdings. Um, you can see that these haven't changed. We've went over these before. I don't see any new stocks in this list. We have NVIDIA, Microsoft, Amazon, Broadcom, Meta, JP Morgan, Taiwan Semiconductor, Netflix, Visa, and Kele Tencor. And you can see that the Contra Fund has very, very similar stocks. They have Alphabet where the other one doesn't. And they have Microsoft and Alphabet. Everything else is basically the same. So the reason I'm going over this, this looks a lot like my portfolio. I like to buy stocks that are compounding stocks, stocks that you can buy, hold, and they'll go up 10% or more a year. And sometimes they're on sale. Right now, Microsoft is on sale. You can see it's a top holding of Contrafund. And you can do this research yourself. You could go and search Fidelity Magellan top holdings in Google, and you'll get the Yahoo Finance listing and Morningstar listing of their top holdings. And if it's a top holding of some of the best mutual funds, there's a very good chance if you buy and hold it that it'll perform well for you in the long run. Um, all right, let's look at one more. American funds, the Growth Fund of America. You can see it has very, very similar holdings as the two funds we just went over. It has Tesla and Eli Lilly, where the other ones do not. So that's a good um, it's a good check to have if these very smart people with unlimited resources have stocks that you're holding. There's a good chance that they're good quality stocks that'll continue to grow over time, and you don't have to necessarily sell them. All right, so that was my talk for today. I hope you enjoyed it, and I'll see you next time.